Hello, my name is Melati from the Taxation class batch 2034. In this video, I will explain my analysis for question 1 of the International Tax and Transfer Pricing final exam. I chose question 1 because it focuses on treaty interpretation, permanent establishment, and transfer pricing, which are core issues in international taxation. This case reflects how multinational companies operate in a market without a legal presence, and making the analysis both practical and relevant. A. Assess whether Eurotax has created a permanent establishment in Indonesia under Article 5 of the OECD or UN Model Convention, including dependent agent PA analysis. For Article 5, I analyze whether Eurotax creates a permanent establishment in Indonesia, and Eurotax does not have a fixed place of business in Indonesia, so a fixed place PA does not exist, and however, PT Andalan Technology acts exclusively for Eurotax and is heavily involved in marketing, customer interaction, and negotiating the key contract terms such as pricing and technical specification. Even though contracts are formally signed in Germany, proposal negotiated by AT are usually approved without modification. This shows that AT effectively plays in the principal role in concluding contracts. So, under OECD guidance, substance prevails over form. Therefore, Eurotax is likely to have created a dependent agent permanent establishment in Indonesia. This matters because once a PA exists, Indonesia obtains taxing right over part of Eurotax business profit. B. If a PA exists, expense should be attributed under Article 7 using the authorized OECD approach. Once a permanent establishment is identified, Article 7 requires profit to be attributed using the authorized OECD approach. The AUA treats the PA as a separate and independent enterprise. The first step is identifying a hypothetical PA, followed by functional asset and risk analysis. In this case, the Indonesian PA performs significant sale and negotiation function and bear market-related risks. These are value-creating activities, not merely routine support service. From an economic perspective, profit should follow value creation. Therefore, attributing profit based on only cost plus remuneration may not reflect economic reality, and portion of residual profits should be allocated to the Indonesian PA. C. Evaluate whether the 3.5% service margin and 8% technology fee comply with the AMLE principle under Article 9 and OECD transfer pricing guidelines, including DEMPA consideration. Under Article 9, transactions between related parties must comply with the AMLE principle and 80 receivable cost plus margin of 3.5%, which is below the benchmark range of 6 to 9% for comparable distributor. This suggests that 80 may be remunerated, and in addition, Eurotax charges an 8% technology and know-how fee even though 80 conduct customer training, troubleshooting, and system customization in Indonesia. Under the EMPA framework, return from intangibles should align with the entity's performing value creation, exploitation function, and as a result, these structures raise concern of double dipping and may not fully comply with the arm's length principle. D. Identify key transfer pricing risks and explain the documentation that should be maintained in Indonesia. This structure represents several transactions. This structure presents several transfer pricing risks, including permanent establishment exposure. As understatement of taxable profit in Indonesia and potential mischaracterization of royalty payment. To mitigate this risk, the taxpayer must maintain proper transfer pricing documentation, such as master file, local file, intercompany agreement, and functional NDP under NDEMPA analysis documentation in accordance with Indonesian regulation. E. Recommend how potential double taxation could be resolved through the mutual agreement procedure. If the Indonesian tax authority makes a transfer pricing adjustment, double taxation may arise because Germany may continue taxing the same income. Such as case, the taxpayer might initiate the mutual agreement procedure under Article 25 to obtain a corresponding adjustment. In my personal adjustment, Eureta's current structure presents significant permanent establishment and transfer pricing risk and should be realigned to better reflect economic substance and the arm's length principle. So that's all from me. Thank you.